Many of the outcomes emerging in the next year will be driven by the changed global economic outlook. Inflation, of course, is on the top of most investors' minds. A combination of factors ranging from pandemic-related supply disruptions to global conflict have impaired the manufacture, distribution, and allocation of many goods and services in the product and labor markets. Combined with a burst of economic activity underpinned by economic reopening, as well as unprecedented fiscal and monetary stimulus, insufficient supply relative to demand has boosted price and wage inflation, requiring an aggressive tightening of monetary policies in most major and many smaller economies worldwide. This has led to 5 key changes in the conditions underpinning capital markets. The first one is a flat or inverted yield curves across most government bond markets. Yield curve inversion has followed from the pursuit of tighter monetary policies now underway in most developed and emerging markets. As central banks hike short-term interest rates, expectations for weaker future growth and lower inflation tend to push short-term interest rates above longer-term yields, producing a downward sloping or inverted yield curve. Given the duration of expected monetary policy tightening, a function of today's unusually high inflation, there is a risk that yield curves will remain flat or inverted for most of the next 12 months. Inverted yield curves are often an indicator of an upcoming economic slowdown or recession. The second economic condition is a stronger U.S. dollar. Rising short-term interest rates due to U.S. Federal Reserve tightening have propelled the U.S. dollar higher against most other developed and emerging market currencies. While this may help reduce USA inflation, it exports inflation to other countries. There is also a risk that countries or companies with high dollar debt could default on their loan payments. The third condition is elevated price volatility in most asset classes. Unsurprisingly, when central banks tighten aggressively, price volatility tends to rise across all asset classes. Already underway, that process is likely to endure. Unfortunately, this means that asset classes are more correlated than usual. Both stocks and bonds have performed badly at the same time, making it very hard to protect your portfolio. Fourth, diminishing central bank support for financial markets, including in terms of lower liquidity and higher interest rates. A commitment to fight inflation implies a reduced willingness to fight other risks, such as recession. That matters to investors, especially stock investors, who for at least a quarter century have counted on significant liquidity, or what is sometimes called the federal put, to provide low interest rates and timely interventions when markets have significantly weakened. That made investors in the past more willing to take risks, which is one reason why both stock and bond valuations have soared in recent decades. Less supportive central banks create more risk. And finally, elevated commodity prices. Typically, higher interest rates, stronger US dollar, weaker growth would erode commodity prices. That may occur for some commodities, particularly those that are most cyclical, such as industrial metals. But supply-side factors are also an important factor, including the squeeze on global energy, food, and fertilizer prices resulting from Russia's invasion of Ukraine. Supplies of crude oil and natural gas globally remain very tight. The rise in commodity prices is even more severe overseas, as most commodities are priced in the ever-rising dollar. Opportunities exist in all market outcomes, and today is no different. Our investment teams have shared their views of market opportunities. Some of the opportunities our investment teams are finding include, within fixed income, being more attractive relative to equities for income generation. Higher yields present opportunities across the duration spectrum. Longer-term bonds could make sense if you think inflation will fall and the economy is going to slow. Many markets and emerging markets have already priced in high inflation and have already had rate hikes and may provide opportunities for fixed income investors. Within equities, companies with dominant market positions or the ability to reduce costs can support earnings growth despite a more challenging economic background. Companies with meaningful capital return programs, either through dividends or large share buybacks, are likely to fare better. In emerging market equity, structural themes remain very attractive, such as the electrification of transport, digitization, and high quality in the consumer sectors. Within alternatives, the drivers of private real estate remain strong, particularly in the industrial segment, leading to inflation-protected rents. Please read our global investment paper for more details.